I seen that peanut number one. Welcome everybody. We'll give it a few minutes here and let some people show up. Not expecting a great turnout tonight, unfortunately. When we talk safe, responsible trading, people tend to not really want to come to those classes. So we'll see how we do.
What up, River?
Norbin, how we doing?
Good, bro. I got a flat tire going to work.
Oh no, dude, get yourself some new shoes on that car, dude. Delivering all that black gold, dude. You got to get yourself to work.
Yeah, it was unfortunate, but good thing it didn't pop and I crashed, bro. So,
You crashed also?
no, I said good thing I didn't crash.
Oh yeah, true. Welcome everybody. How you doing? Well, your part today doubling down on zero DTs. Well, at least you lived up to your name. You know what they say. Oh, and TTD, I know. I should be in there. We had our bottom entry. I've been on this thing. I should have just bought it. I'm hoping they give me one more down. I'd love to see us set a new low, and then I'm a buyer. But I very well could have missed it down here, that 43 zone. But I like it. I like it. But man, I mean, and I will always happily say when I'm wrong. I mean, I was talking with Intel earlier today. This was a stock I was dead wrong on. I was super bullish on TTD. I mean, obviously caught a nice run when, everything was running and things were going good, I just, based on these last few quarters, I am having that like rough realization that I was definitely a little bit wrong on TTD. We'll see. But see way back here, whenever this was 2022, something I should really put that line on the chart. This is like would be the final dip I was looking for. Get us down, even really just below this low, somewhere between 42.89, 41. I'm definitely a buyer on it. I think if you're in there now, it's great. I think you have to buy this. I haven't looked at it. I'm willing to bet that all of a sudden its financials are looking pretty dang good in regards to its valuation. So I think, it's definitely getting to be that buy time. No, this would definitely be a long swing. No weeklies on this, it's cheap enough. I mean, I haven't, if I'm entirely honest with you, I haven't even looked into contracts. You could buy shares on it. I mean, shares are super safe down here. You got like at most at 5 or 10% risk on shares, but no, I'd definitely be trading this thing with time. And well, you can see, obviously you'd want to get back to this main consolidation, but my real main target would be about this 57, the start of the gap, and I mean, that's a nice big, $10 move up from here. Uh, because that's where the market will make its decision on TTD. Was this a massive overreaction or not is yet to be seen. So far they're deciding it was not an overreaction. So we just got to give it a little bit more time and see what they want to do with it. But definitely a trade that I'm liking for a swing. I'm liking this nice base holding. I also, you guys know, I was liking this nice base holding up here above 50, which ultimately didn't work out. But I do think with a little bit of time, TTD is definitely going to be one that wants to do a bit of running. And we know what it can do when, things are going good. Uh, just got to turn some things around. Oh, nice. You're swinging some November calls. I like that. Yeah. Yeah. And exactly. Guidance wasn't great. Financials are doing, I mean, financials are fine. Revenue's good. But they didn't like that guide. Nope, no check and spy. We aren't really doing charts tonight. I can't say that. We'll see how long that all this talking takes. But nope, not much of a charting lecture tonight at all. That was kind of what I was mentioning. Let me make one more post and we'll get to rolling here. Okay, and with that, we will get rolling. Welcome everybody. Happy to have you here, Dirty River. Tonight, definitely different lecture than I gave. You guys know me. I love technical analysis. I love fundamental analysis. I like all those sides of the market. It's absolutely crucial. I am a staunch believer that you can trade this market without technical analysis, but you will never be as good as you could be without getting on those charts a little bit. And so tonight, definitely not a lot of technical analysis going on. We are talking about how to trade, how to, not be over leveraged. We're of course going to take some things back to the charts when we start discussing position sizing and things like that. But you know, trading the charts, like, I can teach, I like to think, maybe I can't, but I can teach anybody technical analysis. It's a very repeatable thing. You do XYZ over and over and over and over again, and, it works or it doesn't work, but it makes everything nice and cut and dry for you. The technical analysis side, the charting side, the reading fundamental side of trading is all relatively easy. As crazy as that sounds, and don't get me wrong, you can get deep on this stuff and you can start, learning about like European Black-Scholes calculation, Sharpe's ratios, all of these different, very advanced sides of trading. However, if you don't know how to manage your money and you don't know how to manage your portfolio, you can be the best charting person on the planet and still lose money. And so that's what we're going to talk a little bit about tonight. We before, and I see even somebody, Anastasia, mentioning it right now. Last week, I think that was last week, maybe 2 weeks ago. Our class was, it was trading psychology with specific focus on things like greed and, going on tilt and those kinds of things. Definitely a tough lecture to have, a tough lecture for a lot of people to listen to because so often it applies to you. Well, tonight, like I said, it's going to be a little bit different. We're going to talk about position sizing. And I want to, and managing positions based on your position size, managing trades based on profits, all of the, I don't know how else to put it, but the back end side of trading, the things that really make it work, that make it so, the losses don't absolutely kill you, make you not be that person out there looking for the home runs. So we're going to talk about, over leveraging, proper position sizing. I even mentioned some goals. I think trading goals for the most part are one of the most horrible things that you can have. Just random example, say you want to make $100 a day. See, so funny. So say you want to make $100 a day. Well, you go and make 98 bucks. And then you say, okay, well, I need to make $2 more to reach my goal. And then you lose that 98 bucks you made, that is why goals are bad. They will start to make you do some dumb things. So I'm going to talk about, you know, how to manage your money, some real goals that you can set these goals and they don't matter. Like, you reach them or you don't reach them, but you don't want to do things like set a daily goal. You want to say, I want to have a realistic goal, and we'll talk more on these, a more realistic goal is something like I want to have more green weeks than I have red weeks this year, and so with that, again, we're just going to get rolling. A lot of things to talk about tonight. I'm going to encourage I'm going to encourage everybody to chime in and ask questions. The first part I want to start with, this is just going to be a little bit of talking, and then we're definitely going to get into some more group participation, hopefully some more group participation. And so what I want to start all of this with is kind of the realities of trading. They're the things that everybody ignores, nobody thinks about, and it's the truth. People view the stock market as this get rich quick kind of thing. And are there times and places where you can make a very large amount of money in a very short amount of time? Absolutely. But they are not the norm. Consistency is what matters in trading. There is not, in my personal opinion, a better example on the planet of the idea of marathon, not a sprint. That is the stock market. The touchy side of it is very, very, very difficult thing to do. I'm sure that you guys have seen me mention it in trade floor, all those kinds of things like that. When we are trading, when we're trading in the market, we are trading in, no exaggeration. Well, I mean, technically, maybe the bond market, but no exaggeration, the most advanced financial market on the entire planet. Then, when we're trading derivatives, and for anybody who doesn't know what a derivative is, it's an option. Then we're trading derivatives. And when you are trading derivatives, you are trading one of the most advanced financial instruments in the most advanced financial markets. So when we are trading, how I always like to describe it to people, we are trading in a market, and I'll use the term against, although we should ideally be trading in the same direction as them, but we're trading against multi-billion dollar hedge funds. We got people working at these hedge funds that have PhDs in finance, in economics. We got theoretical math people like programming those algos. And so people so oftentimes think they can show up to the market. And, I mean, I don't want to call anybody out, but, we got somebody right here. I want to make $1,000 like Grizz does. I want to make $100 a day. Fine. And that's great, but you have to be realistic and you have to understand what you're doing. And you have to understand that when you are trading in this extremely advanced market, you are not going to just show up and learn how to trade. I mean, I see it all the time. Everybody knows I do one-on-ones, I do teaching. Like I've taught multiple classes. Well, I mean, multiple classes a week for years in OOT. My DMs are full of people asking questions all the time. And one of the most common things I hear is, I watch this YouTube video. This is how this guy trades. I'm going to try it. That is never going to work. And don't get me wrong, maybe you watch my YouTube videos. I am telling you right here, right now, one little YouTube video isn't teaching you anything. When you look at the very good traders in OOT, like people that even I look up to, your Sharks, your Tilios, those kinds of people, they are that good due to time and effort. If you think you're going to show up, pay for a Discord subscription, learn how to trade, and you're going to be, some full-time trader, you can quit your job within a few months, I hate to tell you, you're in for a very rude awakening. Depends on what statistic you look at. 90% of day traders fail. And it's unfortunate. However, it is entirely expected. After the amount of time I've talked to people, learned how people think about the stock market, it becomes very, very easy for me to understand why everybody fails. And it sucks, and for somebody like me who sits here and teaches, I hate seeing people fail. There's nothing I hate more than, friends in here or acquaintances or whatever in this group losing money. I want everybody making money. And the other side of this that I have learned from talking with people is that if you put in the time, if you put in the effort, and if you actually want to learn, you can absolutely make it as a day trader. I'm not going to tell you you're going to, quit your job or anything like that, and, strictly trade stocks, but it is a very, very real goal and real idea and possible idea to become a day trader that makes a very good amount on the side of, your other job or whatever it is to have some extra money. And so it is very possible to succeed, but only if you put in effort. And don't get me wrong, you can get in this group and you can follow analysts and you can absolutely make money. We are super lucky in this Discord that, you know, people in here know how to trade and our analysts know how to trade, and you will very likely make money following them as long as you are doing as they tell you what to do. However, as far as longevity in the market, you will eventually need to start learning. And so, as I was saying, not much of a technical analysis class today. Tonight we are learning about how to actually be a trader. This isn't, this is the not necessarily even the mental side, but this is, like I said, that back end, the things you need to think about before any trade that make it so trading actually works for you. And so tonight we're going to start with position sizing. And how I like to position size and how I think other people should likely like to position size. Some things you can do with that, and different positions for different trades, how to treat these different trades. And so tonight, I did want to ask, just for, I don't care how much money you trade with, but for tonight, I was thinking we were basically just going to talk about like a $2,000 port, because that's a common amount. You can trade with less, and we'll touch on it a little bit. But there are aspects of what we are going to touch on that at a small enough portfolio has some unfortunate things that happen with it. I see Mario saying right here something that I'm about to tell you here in just a second. 5% of your port, pretty reasonable for day trades. There's an issue with that. And so why we're going to talk about a $2,000 port and just kind of use the $2,000 port on your example tonight, or on my example tonight, is because when you are properly position sized, if your port is too small, it starts to be relatively difficult to find trades that not only meet the risk management side of things, but are reasonable enough for your portfolio size. If you're trying to trade with 400 or 500 bucks, you can't really trade with time without being over leveraged. Of course, there's some of those cheaper names that I recommend to everybody: AT&T's, Coca-Cola's, Bank of America's. There's countless cheaper names to trade. However, if you're trying to stay within that 5% position size on, day trades, then if you have a $500 port, that means you only got 25 bucks to work with on a trade, without finding yourself over leveraged. And so with that, we're going to start talking it. As long as everybody's fine, $2,000 port. If you ever want to have questions about sizing for your port specifically, I encourage you to DM me. I'll talk about this with anybody, anytime. So position sizing. We have our $2,000 portfolio. There's very, there's, so when we have our $2,000 portfolio, and there is, technically speaking, three types of trades in the market. Tonight we are obviously we are focusing on options, and unlike options in our portfolio, this isn't so much on stocks. Obviously, stocks can end up as a slightly larger position, but we aren't getting into that. When we're talking derivatives, for the most part, there is three types of trades. We got our scalps, we got our day trades, and we got our swing trades. Me personally, if I'm scalping, 2.5%, or half of a day trade position size. That's where I think most people should feel comfortable. Day trades, 5%. There is no reason to go more than 5% of your port in any trade. Swing trades are kind of a tricky one. I'm going to say something right now that I'm sure many, many people are going to disagree with, but I hate to tell you, it's the cut and dry facts. There is not a riskier type of option trading than swing trading. You are completely at the whim of the market. You have no control over your positions. And when things start to go wrong, they can go very, very wrong, and you have no ability to fix that. That's why most people should focus on day trades. Swing trading, very, very dangerous, especially if, and we're going to get into this in a little bit, especially if you aren't doing things to manage those positions. On the other end, scalping. you've noticed on scalp, or sorry, so swing trades, final thing. Generally speaking, for me, I am not going to try to be above somewhere from 7.5 to 10% of my port. There's no reason to have more than that. I personally also think that's a little bit high. And the reason that it gets a little bit higher is because we are trading those contracts with time. So we know that if we if that trade goes against us, we aren't going to be fighting theta. We aren't going to be fighting those other things about it. We can have a more defined risk when it comes to those longer term options, because for the most part the movement we see in for the most part, the movement that we see on those contracts is really going to be your delta movement. Again, we aren't talking about Greeks or anything tonight, but basically, you aren't going to lose or gain too much value or anything like that overnight if it's not moving very much. Why is swings trading so dangerous? I mean, this is an appalling example, especially because it's ER and everything. Well, this can happen. You can shave 50% of your value overnight. And if you have 10% of your portfolio in there, as options traders, we need to understand the wrong news at the wrong time truly can turn these trades into 100% losses. So if you are not very, very comfortable with, that potentially going to zero, then you can't size into it. You can't go into it. If you have half of your port in there and it goes against you, then all of a sudden half of your port is gone. So you need to be trading with an amount that, in worst case scenario, um, you're going to be fine. You're going to come out of it okay. It's not going to ruin your trading. You're still going to be able to continue trading. Living to fight another day is one of the most important things in trading. So now, on the other end of this, scalping. And you guys are going to crack up at this. I actually see a couple funny comments about this. You shouldn't scalp. Nobody should really scalp unless you love it. That is why I scalp. It's something that I really enjoy doing in the market. I have fun doing it. I love being able to sneak a small little amount of money out of the market very quickly. You notice my size is small on these. I'm not looking for huge gains. In fact, mostly what I am doing with my scalp trades is trying to make those little bits of money to finance the day trades and the swing trades. Maybe I have a day trade going and I'm a little bit red on it. Plan's still intact. I'm still holding. Everything's good. I might sneak in a little spy scalp. And, one of the big issues I see with people is they always think in dollar amount. They never think in percent amount. So, AT&T is one of my favorite things to trade. Everybody knows that. I get ridiculed for it. I get ridiculed for it all the time because, I'll post a 40% gain. We had one today, and people will be like, that's $12. Who cares? And fine, that's valid. It is. It's only 12 bucks. Is it changing your life? Absolutely not. When you properly position size for these kinds of trades, I'm not buying one $30 contract of AT&T. I'm sizing into my normal position. So you think in those percentage amounts. And I see it all the time with swing trading. People will, hold these swing trades for a week, 2 weeks, whatever it is, go minus 40, 50, 60%. And then all of a sudden they're making 20%, 25%, whatever it is. And they're on top of the world. And that's a bad trade. I mean, like, those aren't good trades. You got 3 risk, 1 reward. It's a terrible trade. Like you need to be right every single time. Otherwise, you're never making money in the market if you trade like that. So these little scalps, these little day trades, they finance other trades, and that percent is what matters. AT&T, you guys can see right here and this was the trade that we took. So I'll use me as the specific example. I got AT&T calls yesterday. We hit them. I don't remember. AT&T did nothing yesterday. We hit them, I don't know, on one of these dips here. So we went a little red, we went a little green. I chose to swing these yesterday. AT&T, we bought one of these little dips here. I don't remember. Maybe we even bought it here. I don't remember. Hardly any loss. And so I decided to swing these things and they ultimately paid. I mean, I could pull it. Let me pull up my spreadsheet just so I can tell you. I mean, and we paid 33 bucks for them. We cashed them out at 50 bucks. So it's 17 bucks a contract. That's not, that's nothing crazy. Well, I had a 5% of my port position size in that. So sure, it's only 17 bucks, but when you times it by more, it starts to add up really, really quickly. So then I also had an Amazon swing that I was throttled on, and I was able to cover that with the T trade. So it's all about managing this money. And I use scalps for that. You guys will see it on SPY all the time. We take a lot of trades in voice chat, we take a lot of SPY trades, we take a lot of QQQ trades. And oftentimes they're paying us 10 or $15 a contract. That's pretty common for what we get out of those. Well, that doesn't sound like a lot, but they're $30 contracts, $40 contracts, whatever it might be. So we are consistently getting these 30% returns. And people have this very hard job, oh, well, this swing trade paid us 20%. And they were whatever, $300 contracts. So I made 60 bucks. Well, if you have $300 in SPY calls and you make 20%, it's the exact same thing. But people get this in their head that, oh, swing trade, more money, that percent is more dollars. You need to think in position size and percentages, not in dollar amount. Obviously, you don't want to be going full position in same day SPY scalps or SPX or QQQ because you can start to take losses. And if you aren't good at scalping and you aren't good at, stopping out of trades when you need to, then scalping is very, very likely not for you. So when we are trading, our $2,000 account, most of dude, full port, you are on one tonight. So most of what we are doing or people should be doing is day trades. And why is that? Well, scalps should be enjoyable and to finance day trades. They shouldn't be what you are trying to make all of your money on. Swing trades are inherently much more risky. So when you are swing trading, you better have a really, really, really good setup. Prime example in OOT is Shark. He doesn't alert a lot. He's missed so far. I think he's had like one. Starbucks is the only thing I think he's alerted that hasn't paid so far. And so, and so that is good trading. That is good swing trading. There isn't 10 setups in the market all the time to have 10 swing trades on. Um, you will always do better in this quality over quantity thing on swing trades, and Shark, there is nobody that is a better example than Shark of quality over quantity. And so most people should be focusing on day trades with around 5% of your port. Now, there's a second side to position sizing. A scalp, generally speaking, you're only going to have one open at a time. I mean, today was a funny day where we were actually short both QQQ and SPY at the same time. But the setup was there for the scalp on both of them. That's not the norm. Generally speaking, you're only going to have a scalp open, one position. Day trades, you might have, two. Three is too much. Three is definitely, you're starting to push it. And why do I say that? Because if you are following this position sizing and you have 5% of your port in a trade, well, now you have 15% of your port in a trade, which is over leveraged, without a doubt. Because you you are putting yourself in the situation where if something happens in the market, which we're talking about this right now because of trade floor. Um, you know, Here's SPY. Is it down the last couple days? Yes. We are down 1.93%. We are trading at levels that we haven't seen in looks like 9 days, 8 days, and people are destroyed. We saw it in trade floor. I heard it in voice chat. People are over leveraged. You have too much of your portfolio in trades. If your port is getting crushed by 10, 20, 30, 40% on a 1%, 2% pullback on SPY, you are over leveraged, no questions asked. And so if you have too many day trades open, you're in it way too heavy and you can risk losing too much money. Swing trades get even worse. If you own, like I've been seeing it on trade floor, I'm out of buying power to buy a swing because you have too many swings open. And we all talk about full port, and we got full port in here right now. People always think of full porting as one trade. It doesn't have to be one trade. If your full port is in trades, you will get wrecked. We're seeing it right now. I know that there's a lot of people long on these growth names that are just ripping and they're chasing it. Soundhound went on an absolute ripper. Everybody's chased it. And now we're down 16% off the highs in 2 days, and people are wrecked. Another one, Rocket Lab. Everybody chases it just to have us be down, 13% in 2 days. If your whole port is in, if your whole port is in trades, then you're going to start getting wrecked on these kinds of things. Yeah, Peanut, Oklo. I mean, this one, it felt like it was unbeatable, unprofitable company, blah, blah, blah. And here we are. We were down 23% off the open from yesterday's highs. And we're seeing it in trade floor. And I know that there's a lot of alerts in OOT. And don't get me wrong, you're the ones clicking the buy button. But when you see 10, 15, 20 trades in front of your face, you want to start buying them. And most people's portfolios can't handle that. So full porting doesn't just mean one trade. If you have 6, 7, 8 swing trades open, you're over leveraged. This obviously the idea changes as our port grows. So this is going to be funny to people. And people are going to think it sounds crazy. As your portfolio grows, you need to be reducing position size. You got a 20K portfolio, then you don't need to be putting 5% into day trades. You don't need to be putting $2,000 into a swing trade. All you are doing is opening yourself up to losing more money. So as port grows, $100,000 port person is not going to follow the 5% rule because they've grown that money likely in a smart way. I mean, I know some people get there quick in a hurry by accident, but most people don't. If they've grown their money in a smart way, they've likely found a position size that they are comfortable trading in. It might be $1, $2, $3,000, even though they have $100,000 account. So size is always going to reduce as port grows. It should not be this like, oh, well, I made 5K this week, I made 10K the next week, I'm putting it all in this next trade. It's a great way to lose it all. And so we are seeing that, heavily in trade floor right now, where people are just full porting things and they don't think about what they're doing. And they don't realize, like, we get one downturn in the market, and we saw it today. I mean, I saw it all day long on trade floor. People saying, I am wrecked. I am wrecked. This shouldn't wreck you. A little pullback in the market should not wreck you. Your port should be fine. Your port should be protected on it. However, it's yeah, yeah, there's been a lot of examples of it. You know, However, you still can be involved in the market, and we all take losses. In no way am I trying to ridicule people into, saying, oh, don't trade, you're doing everything wrong, blah, 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 nothing like that. But step one to fixing problems will almost always be sizing down. And so with that, I want to start talking about the actual making money side of things, and start doing some simple math with you guys so that you can maybe start position sizing and actually realize what you can do. And for the full porters that are never going to learn, that aren't here to learn, that throw out stupid price targets, they're the people everybody's laughing at on trade floor, they're never going to learn. If you are wanting to be a responsible trader and actually see what the market can do for you, we're going to talk about that a little bit here. So we're just going to say hypothetically that we're only taking day trades. We're going to ignore scalps and we're going to ignore swing trades. they can work great, they can be fun, you can make a bunch of money, you can lose a bunch of money. We're going to focus on day trades because they're safe and you can find some nice consistency with them. So, what as I said earlier, I don't like goals in the market. If you start setting goals, that's when you start making dumb decisions. However, I will say that a reasonable goal in the market that everybody can attain without being over leveraged and is relatively easy to accomplish. Um, we're going to talk about what these small gains do for you. So what I have pulled up here, I think you guys can see it. I think I got that on my screen. So what I have pulled up here is a compound interest calculator, and we're still going to be focusing on our $2,000 trades. So, or our $2,000 port. So when we have our $2,000 port and we know that we want to be taking those, 5% of our port positions, $100. That's what is safe for you to be putting in a day trade. And so those are the types of trades you should look for. And for this example, we are going to you know, we're going to pretend everything is hunky dory and that we're going to do this and we're going to follow all of our rules and everything's perfect. And I understand that trading is not like that. But we want to be trading our $100 position sizes. And a very realistic goal for portfolio growth in a day. And we're talking smaller portfolios. If you got 150K, 200K, this is a little, you're playing with more money, it can get a little bit more tenuous for you. $2,000 port, you might want to make 1% a day. So I know that doesn't sound like much, and I know that everybody wants to see way more than that. Well, what is 1% a day? It's $20. That's it. That's all, that $20 is 1% a day on your port starting in the beginning. Obviously, the next day it'll be 20 and some cents, and again 20 and some cents, and a little bit more. But we have to look at this and say, okay, we want to make our $20 in the day and we want to trade these $100 position sizes. What can we do here? Well, what I always try to tell people is two trades, make 10%. Um, we know the market hands out 10% trades all day, every single day. So if we make 10% on a $100 trade, we make $10. We need to do that 2 times. And our goal, though I don't like using the term goal and I don't think people should set goals, our goal is 1% a day. We need two trades that pay us 10% or one trade that pays us 20%, whatever, but we need two trades that make us 10%. And it's $20. It doesn't sound like a lot. Well, here's where our compound gains calculator comes into play. We have a $2,000 portfolio. We want to make 1% daily in 1 year. We know that the stock market doesn't trade on the weekends. So do we include all days of the week? No, we include Monday, Tuesday, Wednesday, Thursday, Friday. So, we're looking at this, and again, this is $20 in a day. And this is you starting with your $2,000 portfolio and you being able to find yourself 10% trades a day, which I truly believe every single trader is capable of doing. Well, if we start with our $2,000, we get our 1% a day and we do it for the whole year. And some of these we can average out and say maybe we made more on some days, maybe we lost money on some days, but we average out to about 1% a day on the year. We will do 1,200% on our money. That is an appalling return. Our $2,000 will turn into, $26,000 by the end of the year. And that all starts with 20 bucks a day. And I truly believe anybody is capable of doing this. I get that people want a full port. They want to get heavy. They want to do this, that, and the other and try to make their money fast. This is a 1,000 plus percent return on your portfolio in a week. You can hop on the charts, I guarantee you. And in 30 minutes on any day of the week, you can find two trades that will pay you 10% that can give you this type of a return on your portfolio. It is a very reasonable goal. You will never find yourself over leveraged. You will never have to swing trade and be the person on trade floor saying, I'm wrecked because I'm in 10 swings, all from one small or two small trades a day. And exactly what always be what he's saying here. 1% is more and more every day. So the first day's 20 bucks, the next day is $20.10 or whatever it is. Well, do that for, 30 days and now it's 30 bucks a day. You are still putting 5% of your port in a trade, looking for 10% on one trade, and you will 1,000% your money by the end of the year. Is going from 2 grand to 26 grand in a year going to change your life and you're going to be able to retire and every single thing, all of your life's problems are fixed? Absolutely not. However, find me somebody that an extra 20 grand a year doesn't help them and give me their number because I'm asking them for a loan. They're probably rich, but this is very, very doable. Don't be the person YOLOing. Don't be the person looking for home runs. Don't be the person, oh, if I held, I would have made more, be the person that gets in there, trades, and extracts your money from the market. This type of logic is used from the bottom to the top of traders, from a person who is, the beginner retail trader on Robinhood. You can benefit from this. To the person who is the desk trader at JP Morgan, you can benefit from this. They will all have goals that, and not necessarily goals, but a point where they stop. And that's even, I've talked to some desk traders, and a lot of them say, my job is to get X amount of points trading futures at my desk. If I can do that in 5 minutes, great. If it takes me 6 hours to do that, great. This is my job. I need to find myself into X amount of points of futures a day. That's what we need to do as traders. We need to be realistic. We need to trade in reality. And most people lack the patience to do this. That is one of the most difficult things for people to understand. And it takes us all the way back to the very first thing that I was saying in this lecture. There is not a thing on the planet that shows you marathon, not a sprint, better than the stock market. I see somebody asking here, can you change the projection to 2 years? Absolutely. I do have to point out this number is going to be large. And it gets more difficult the more money you have to accomplish that 1% a day. 1% a day when it's 20 bucks, piece of cake. 1% a day when it's 2 grand, 3 grand, 4 grand starts to mess with your mental a little bit more, but run it out for 2 years. There you go. I mean, that is the power of compounding gains. I mean, I try to explain this to people all the time, the power that the market that we have gives us for such little effort. And so again, can somebody run for an entire year, for 2 years straight, hitting 1% a day every single day? More than likely not. You are going to accrue some losses. You can't just be sitting there with your, $350,000 port, at the market trying to chuck in your, put on your 15, $20,000 position sizes. Things go wrong. They do go wrong eventually. So that was kind of why I wanted to give that disclaimer before this. It doesn't always work like this. You won't always be able to do 1% a day. I just really want to emphasize to people, when you are starting and you have a smaller amount of capital, it is a don't, I see people all the time. Oh, don't even waste your time with a $500 port. You know, is it a waste of time? Maybe, maybe not. But you have to learn somewhere. You have to start somewhere. And with patience and perseverance, you can turn that $500 port into a very substantial amount of money. Is it going to be fast? No. You can be the person that turns 500 into 5,000 in a week, but those people oftentimes turn that 5,000 into zero the next week. We've seen it, it's a tale as old as time. And so this little part of this lecture, if you take nothing else from this lecture, take this from it. See what you can do. With being realistic, with taking these smart trades. Do this time and time and time again, and you will find yourself making some very nice money. As I said, is $20,000 going to, change your life and solve all of your issues? Absolutely not. But it's going to make your life a little bit better. Even, I mean, we can even look at a small one. You run your $500 port and you have thousands extra by the end of the year. You can turn a $5,000 port very safely into $6,700 by the end of the year. And when you start thinking about it, it is that double-edged sword of you might find yourself a little bit over leveraged, but or I mean, massively over leveraged, sometimes, you might find yourself in $100 position in a $500 port. It does happen. It's not necessarily what you want to do, but if you know you're looking for your 1%, then on day one, you need to make $5. And you have to start somewhere. Is $5 changing your life? Absolutely not. But you can do it. And you keep going. And then you start rolling these. Yeah, look, Crash is saying right as I'm about to say it. You start rolling this money into shares. Maybe you roll some of it into leaps. You let this money continue to work for you, and you use these options to stack it up, put it somewhere else, stack it up, put it somewhere else. Because, then you start thinking about, you know, your because, so this is a funny thing to think about. People always ask me, well, how much should I make? I have this size of account. How much money should I make? Well, you shouldn't make anything. You're here to try to make money, but there is no, you should be making this much, because it just doesn't work like that. Stock market does not owe you anything. And so, oh yeah, I'm happy you're seeing Crash talk about it. Crashness is the OG of ASTS. Market doesn't owe you anything. The size of your port doesn't matter. You just need to be realistic, and you need to be realistic with your goals. People talk about all the time, how much should I make? Well, a rule of thumb, like a hedge fund wants to outperform the S&P. That's their goal. And hedge funds have tens of millions, hundreds of millions, billions in some cases. They want to outperform the S&P. The S&P on average does 10% a year. Your 401k is doing 10% a year on average. That's what most people do. Well, this is a little bit better than that. This is only, 124 times better than the average return. And so it be realistic. Know what you can do, know what your returns can be, and know what those small returns do for you. Um, that is the way to grow a port. That is the way to gradually build wealth and to gradually build a large portfolio of stocks. I know, I started all this. We're talking about options tonight. We're talking about managing your money, managing your trades, managing your emotions, and how to properly do all of this. This solves all of it. 99% of people's issues are sized down. And then what do we do with this option money? Leaps and shares. That's what it should all go to. Even, if you are a more risk averse person, one of my good friends, I work with him in here all the time. He's a good trader. Uh, his real job, I wonder if he's in here. He's going to laugh when he hears me talking about him. His real job is literally risk aversion for the company that he works for. His job is to make them not be risky financially. So he comes to the stock market where you have to put risk on. And it's a hard thing for him, because he doesn't like to see the money go away. He's a great trader, good charter, everything, like he's doing fine. He's not hurting or anything. But he has a little bit of trouble of letting things work because his job is quite literally not letting risks work for very long. That's what he does. And so that's what we need to do. Our options port is our high risk portfolio. that is and mostly should be there to fund your long-term portfolio that is substantially lower risk. Don't get me wrong, in your portfolios, is it fine to hold some of these like high flyer growth stocks? What's one I keep Cypher or whatever? People keep talking about this one, you know? I mean, I don't even know this is a real company. I don't know anything about it. It's fine to own some of this. You shouldn't be full boated in this thing, you know, because this kind of stuff happens. So you shouldn't be full boated into a trade like this, but dedicate a little of your longer term portfolio, especially when young, to some high risk assets. But for the most part, go low risk in that long term portfolio and give it time, you know? Find somebody who bought Apple in 2009 that's sad. They aren't. They don't exist, you know? And so long-term portfolio is for time in the market, all of that. Leaps, shares, don't care what it is. Our options portfolio is best used for shorter to midterm volatility with higher risk. Our job as traders is to, our job as traders is to keep that risk as low as we can and make as much as we can with yeah, there you go. And are you sad? Probably not. Our goal, my opinion, our goal as a trader is to make as much as we can with as little as we can. Not only as little capital usage, but as little risk as possible. Anybody who's traded with me knows that when I am trading options, I am extremely risk averse. We don't need big risk in this market. If all of your trades, and I don't care, swings, leaps, any of that, one of the worst reasons that you can, like, when people ask me for advice on trades, the reason that I hate the most to hear that they're still holding is I have time. Just because you have time does not make it a reason to hold. If this is truly long term, true leaps, I keep hearing people say, I'm buying leaps. Then they buy a 3 month out contract. A leap is not a leap until you're over a year of time. That's what a true leap is. So you need a year of time for it to really be a leap. Those ones, obviously, they are more than options, they're leverage shares. They are a share position that is leverage that you buy at a massive discount versus buying the shares. I was looking at Mercado Libre contracts with a friend of mine. They're very expensive, but you're getting about 40 delta on some of them for $3,000. I know that's a very expensive contract. Well, if you wanted to go out and buy 40 shares of Mercado Libre, you're in it 100 grand. So leaps are leverage shares. They should be treated as leverage shares where you understand you can see some red on that. However, leap should be, and I mean, maybe you only have one portfolio and like that's fine and everything. Leap shouldn't like really be in your option portfolio. They should be in your share long-term portfolio that you don't mess with as much and you're still trading those shorter term options, up and down while holding the leap for the longer term move you expect. But as day traders, again, yeah, leaps in the rough. Again, I just want to put it out there. If you take nothing else from this lecture, I don't care what it, if you don't care about anything else I said, focus on day trades with 5% of your port and try to, as best of your ability, achieve 1% a day. Again, if you take nothing else from that, if you just try to do those things, you will find yourself so much more successful. Yeah, day trading in a Roth is a bad idea. You know, Roths are fine. You can do some trading in there, to have those tax benefits if you want. I personally don't have a Roth. I wouldn't recommend against people having them, but I personally don't have a Roth. But a Roth should not be risk. That's not where you want. And again, some higher risk shares. Look at this Cipher thing. What's some of those other ones people talk about? Zeta or whatever. That's one Twitter favorite. I have no idea what it is or what it does. I can't tell you if it's a good company or not. But yeah, you can hit some of these riskies to look for that potential big return on them. But if you're doing risk in your Roth, do it with shares. Don't do it with things that go to zero. That's a good rule of thumb. Roth should be for safe things and things that don't go to zero, like options do. Of course, a leap can go to zero, but like if a leap goes to zero, something went really, really wrong. And so, God, we're almost at the end of it. But with that, that's all I got. Any questions, any concerns, anything that applies to you? Uh, there was a couple more things I wanted to talk about, but any questions here? I know I talked a lot. We talked about a lot of things. Anything you agree with, anything you disagree with, anything you don't understand, let me know. Yes, exactly, exactly. Yeah, and you already pay taxes on it, and then if you decide that you have to take it out early, you are also going to pay taxes and fees again. So be cautious doing anything in the Roth that is risky and makes you want to change what you're doing in the Roth. You know, Roth should be buys and holds for the most part, and things you don't really have to think about. Yeah. So runners. Yeah. Let's talk about it a little bit. And I think I know who you are. Runners and stop losses. Okay. Uh, so this is going to go back to the charts. Runners, you need to let the chart tell you what to do. So for me, and this is my easiest way, and it doesn't matter, 5 minute, 15 minute, obviously on your scalps, you're going to be thinking more 5 minutes. On day trades and swings, you're going to be thinking a little bit, longer term, and longer time frames. As I teach it all the time, it doesn't matter if you it doesn't matter if you're, what trade you're in and what time frame you're looking at, you treat all charts the same. So my favorite way to tell people to manage a trade that they're in, and we're going to use this 5 minute chart, we're going to pretend that we're the greatest traders ever. Well, you can do this on the daily chart for swings, or the 4 hour chart for swings, or those hourly charts for day trades. So we short Zeta. And again, this is completely random. How I decide if I'm going to continue holding is I let the candles tell me what to do. In trading, there's two types of candles. There's range trading candles. They're things with big wicks on top and bottom, not really going anywhere. And there's trending candles. Trending candles are big bodies closing near their lows in the direction you want it to go. So, what I do when I am day trading or swing trading, I let the candles tell me what to do. And I look for breakouts, and I move my stop to the breakout or breakdown location. So on something like Zeta, whatever it is, we short it here. Well, we get our breakdown. To me, here is our breakdown level. We know this is a breakdown because we broke support, bearish candle closing near its low. You move your stop to here. We continue going, we're chopping, we're chopping, we're chopping. Another bearish candle closing near its low below supports. We now have a new breakdown. Here's our breakdown level. Where did our breakdown come on this candle? We move it to the top of the candle. We sell down, we get some consolidation, we bounce up, we keep selling, we keep selling, we keep selling. Here is another breakdown. So we've broken, we tried to hold this support. We've now broken below that support. Here's our stop. We now get another breakdown. Here is our stop. We now continue to consolidate. We get another breakdown. Here is our stop. And we ultimately get stopped out right here. Let the chart always, always, always tell you what to do. Maybe the 5 minute looks a little bit funky to you. Go to the 15 minute. All of a sudden, your breakdown candles become much more apparent and much easier to focus on, and you don't get hung up in the noise of the market. You will also start to spot things like this that are reversal candles and tell you might want to start stopping out of that trade. You're in nice profit. Again, go to the 30 minute, and you can even use these 30 minute candles. Here's a breakdown candle. Here's another breakdown candle. Here's another breakdown candle. And here's our reversal candle. First one that shows up. The chart never gave you a reason to exit this trade. So this is how you should manage all trades. You can also do the same thing on the daily. Again, we're picking and choosing to make ourselves look great. Well, you don't think Zeta is going to keep going. You see this nice reversal candle, you short the first pop. Well, you're getting paid nice. You know, you've had your breakdown. You're going to move your stop. You've had, another push down, but big buying. Here's your next breakdown. Now your stops are break back over 23. Continued consolidation, breakdown. Set it on the breakdown candle. Another breakdown. Set it here. Maybe this one stops you out a couple days later. This chart is never giving you a reason to exit the trade. So it doesn't matter if you are on the daily time frame, the 5-minute time frame, no matter what it is. These candles are what you want to be trading. When you start finding yourself in consolidation, this isn't necessarily what you want to hold trades. You can start to look at this and say, okay, we're chopping, we're chopping. I want to get out of this trade. I'll look for strong breakout up or continued breakout down. But always let the candles tell you what to do. If you want to learn, if you want to learn a little bit, this is classic price action. Always look for candles closing above their midpoint near their highs. So if we're in, if we buy some calls on a dip, we want to see a candle like this. Or look, this could have been a reversal candle that ultimately you'll get stopped out for basically no loss, but you want to look for a candle like this. You at one point, this candle opened and was red. It is now turned around and buyers have taken over. So these types of candles offer, yes, exactly. Exactly. These types of candles offer entries. Al Brooks calls them a signal candle. Your next candle is theoretically your entry candle. I'm even looking at this. There's some even more advanced things we could be looking at there. This is now your entry candle. So you'll get a reversal candle. You can enter around here. Your stop is down here. Very limited risk on this trade. Of course, not great risk reward because you're looking for the previous resistance, which is where we slowed down, but you got a nice little 1-to-1 risk reward scalp here. I know it's Zeta, it's not worth enough to even scalp that, but strictly the price action on this. Buyers won this candle. It's really the first candle that the buyers have shown up and really won. We can even see a big increase in volume on this, giving us even more confirmation that we're starting to see buyers. Did it turn into a good trade? Is fine. You wouldn't have made a ton, but you would treat it the same. You get these candles up here, kind of closing near their highs, a bunch of consolidation. Here's your first real attempted breakout candle. Your stop's going to go to here and you're ultimately going to get stopped out here. Is it some big, gigantic return? No, in fact, it's like 30 cents, but you let the chart tell you what to do and you give it a try. This is how, number one question I get, how do I hold longer? You only hold longer if the chart tells you to hold longer. I no, if I pull up a chart and it has levels, I did that. I did that. And then, so I'm thinking this is you who is in my DMs. Correct me if I'm wrong. Stop losses. There's two main kinds of stop losses. Yes, I thought that might be it. There's two main kinds of stop losses: limit stops and market stops. Well, they're a double-edged sword. You guys have heard me, I'm sure, for years now. I'm adamantly opposed to market orders. There is never a trade that is so crucial that you click it, you just need to hammer that market button and get in there. There is times where you are all of a sudden getting wrecked on a trade and you need to abort mission as quickly as possible. And so maybe you sell market to just get out of that thing. However, a lot of issues that we hear, specifically Robinhood users, and I'll put it out there, I love Robinhood. This is no disrespect to, this is no disrespect to, Robinhood at all. I love it as a platform. Its number one complaint is it skips people's stops. Well, Robinhood is oftentimes going to be setting you as a limit stop order. So we'll just kind of do this dumb, we're going to have three pretend lines that these theoretically represent the price of an option. This is $20, this is $19, this is $18. So we want to set our stop at $19. Well, if we do it with a limit order, there is very likely hundreds, if not thousands, of other contracts being attempted to be sold at that price. So if we are using a limit and it really starts going against us, there might only be one or two contracts filled at, we might have wanted our stop at 19. And there might only be 1, 2, 3 contracts filled at 19 before it hits 18. And so if you aren't first in line, just how trading luck goes sometimes, 9 times out of 10, they're skipping you. So when you are using a stop order, you should almost always use stop market, which yes, they do have now. So this is the other side of it. Here's our 20, here's our 19, here's our 18. If we set our stop at 19, we are going to get filled at the bid. And if the ask is 19, the bid is 18. And when we do a market order, we are filled at what is known as best available price. That's a very kind word of or way of putting slightly lower than your stop. Every time, you're going to set the stop at 19 and it's going to hit this and you will get destroyed. This situation right here is best case scenario. Worst case scenario is something spready. I'm going to use you as the example. A lot of people trade hood. Hood is spready. Those contracts often have a $5 or $10 spread on them. Well, if you have $100 contract and it goes up to 120, we'll call this 110, and you set your stop at 110. If you get volatility and it comes down and it hits this market stop, there is a very good chance that because there's a $5 or $10 spread on there, you might get filled at 105 or 110. So what was a nice little $100 to $120, 20% return can turn into no win because the market stops you out at best available price. And if best available price is down here, that's where you're getting filled at. You How can you fix this? Well, you can't. You can't really. Robinhood Legends coming a long way. Without being on a computer, you are going to have to just understand that your fill is not going to be as good as what you expected. I might be exaggerating a little bit when I say your stop's at 110 and you'll get filled at 100. Your stop might be at 110, you might get filled at 105. And I'm seeing this, I just saw this message. Oh, I see another one too. Yeah, we'll come back to this. Oh yeah, and you're right. You talked about it right there. You'll get destroyed if the spread is big. That's exactly what I'm talking about here. So what Grizz is saying, you buy your $100 contract. It goes to 120. It goes to 140. You set that thing at 120. He's saying set your stops above break even so that you don't give back all the profit. You don't want to have this contract at 140 and set your stop at 139 because you're getting stopped out. He's saying if you are making the decision to not sell all, you're taking a trim, move your stop above profit. So worst case scenario, you still make money. That's what you want to find yourself in is the worst thing that can happen to you is you make a little bit less money. That's why you move your stop into profit. So Moon, I trade limit orders. 95% of the time. When I set a stop, it's because I'm ratcheting that thing up. We've caught a nice volatile move. We did it. Oh no, it was this one. So Q's today. We took. Let's see. I think we took this short somewhere around here. And so that's what I did. We caught the move down, stops went to the breakout candle. We caught more move down, but I see us coming into all of these EMAs. That's when I put a stop on and I ratchet it up real tight. And I oftentimes get stopped out very quick. So those will be a market stop. My entries, I got to be honest, I do not remember the last time I market ordered into a trade. I just don't do it. I have a price I want to buy at. I've done the quick little risk reward math in my head. And on something like a same day SPY, $5 can be the difference between a 10% trade and a 20% trade, or a 10% loss or a 20% loss. So to me, my entry is crucial. Am I saying if I buy at 60, you shouldn't buy at 61 or 62? No, but I know where I want to be in there for what is, in my opinion, the best risk reward on the trade. Um, well, I kind of can. Uh, I kind of can. sorta. So, let's see. I'm just worried. I don't know what account I'm on. You're gonna have to ask me another time. Can you send me a DM and I'll go over it with you? Moon, sure, every once in a while, but plenty of my trades go red. I mean, don't get me wrong. On occasion, there's ones where it runs right away when I say, "Hey, I bought these." Without a doubt, that happens. But that's not the norm. If I bottom ticked every single trade, like I'd be so rich, you know? But there's undoubtedly times where I say, hey, that shit was way too fast for you guys. I'm sorry. And then those ones, 9 times out of 10, don't even end up on my spreadsheet, you know? If they come back to my entry, I'll make it nice and clear. Oh, yeah, I'm still holding these, or I added some of these back, or whatever, I'll say something like that, But, there are times where they just rip right away. That's part of how I trade. I try to trade at locations where we will get that volatility. Like that's part of my trading strategy. So undoubtedly that is going to happen sometimes, but it's not the norm by any means. And I will say most of the time, 2, 3 bucks above me, you're fine, like I said, a lot of the time we're trading those, 50 to $80 contracts. So you do have to remember that's 10%. I will always take my first trim at the closest minor support or resistance, whichever way we're trading, which oftentimes will be that 10 to 15% for my first trim. Nothing about, I'm not saying always trim your trades at 10%. Like when we shorted these, my first trim was right here because I viewed this spot right here as that first support. And I think they were. I think our first trim was around 10 or 15%, something like that. That trim for me is not so much about making money. Um, uh, yeah, 62 to 70, something like that, or 71. Were you in there? Because I think that's like almost exactly what it was. I don't even remember what it was at this point. Uh, that's not necessarily about making money, but say I got my, whatever, I got my 6, 7, 8 contracts, whatever it is. I got my 6, 7, 8 contracts. Well, I'm gonna sell 3 of these. So now I've got, and we'll just use the numbers you said. Now I have $24 banked. Well, maybe I was risking about 10 bucks a contract on those in my mind. It's based on the chart. It's not based on the value. Well, now I've got 4 left. If I have to stop out at that 10 buck loss a contract, well, I trimmed a few. I got 25 in the bank. I'm only losing 15 bucks on the trade. So that quick early trade for me is just a little bit of finance of the trade. It's not about, that's not the money maker part of the trade. It's what happens after that is where we either make more money or we lose less money. So that's why I trade like that. You'll notice I don't do that on my day trades. I don't do that on my swing trades. That's scalping. We are trading extremely risky things when we're trading same day QQQs and SPYs. Put that money in the bank. I know people in here love to say, hold, we're going up, hold, we're going up, we're dying, whatever is going on. That ain't me. You'll never, I'm not that person. That's not how I talk. That's not how I think about trading. I say the market just gave me $24 in 1 minute. Thank you. That's it. Like, thank you. That's good deal. Like there's people who work an hour of their lives for all I did was watch a candle go down for 1 minute and click a button and I made 24 bucks. So I'm very good at understanding what we are getting for our time. So that's what that first trim is about. Then next trim is the substantial one. My second trim is always my one where and I'm sure, you guys are both saying you've been in VC with me. I'm down to one. I'm down to two. Like I'm down to one or I'm down to two here. And those ones I'll let run or I'll stop out or whatever happens. Those ones don't matter because I took the bulk of the position at my 25, 30%, the next stronger support or resistance. In this case, our first trim was here. Our second trim was here. Then we started ratcheting the stops up on the last two. Those are just runners. That's all they are. They shouldn't be your bread and butter. Even though the runners ended up running 50%, they only made me like, I don't know, 10 extra bucks. In reality, this trim is where the money was made. This trim did a little financing. This trim was where the real money was made. And then you make an extra 10, 20 bucks on those last couple, you know? That's all you're looking for. And that's a scalping mentality right there. Day trades, swing trades, that's what I was demonstrating earlier, using the charts to tell you what to do. Of course, on our scalps, we are still using the charts to tell us what to do. And so, obviously we're going to trim here because it was big resistance that we broke above, and I don't remember this is exactly where me entered. Forgive me if I'm wrong, but this was big resistance turned into support. So we want to trim at the support. We also know the market bounced over and over and over and over right down here. So we want to trim there. Is this some glorious trade? Nah, we caught 75 cents down on SPY, but it paid us 40% in 15 or 20 minutes. We're happy, even if you only had one contract of that 62 to my final sale was at 90, you made 28 bucks in 15 minutes. That's great. That's great money, even if it's just one contract. So again, to bring this full circle, does $1, $2, $3 matter? Not necessarily. You might not trim when I take my first trim because I might be trimming for 10 bucks a contract, but you're trimming for 7 bucks a contract. So maybe you don't quite want to trim there yet. But I'm still just going to tell everybody what I'm doing. And you're exactly right. Some of them explode way too fast, and they're fun and not everybody catches them. And that's unfortunate. But for the most part, so like, like, I've alerted 80 trades in voice chat this month. Um, Most of those did not run like that. Maybe we had 4 or 5 that did. But, we're talking 5% of the time does it work like that? So for the most part, you'll always have time, and then that's just how I'm managing them. Maybe you are less risk averse than I am. So maybe you don't trim until I say, okay, I'm selling a bulk of them here, or I'm peeling a bunch of them off here, whatever I say. Maybe that's what you want to do. But for me, I like to book that money, let a couple more go some more, book a little bit more money, let a few more go some more, and book a little bit more money. And that's it. Yep, always happy to explain. Always, always. Okay, well, that is going to do it. Thank you so much, everybody. Really appreciate it. Yep, yep. Thank you all. Thank you all. I was stoked we ended up with 30 of you in here tonight. So thank you all so much. I really appreciate it. We will catch you all Friday morning. Too much fun. We get to go throw out all of our safe trading habits and trade on Friday morning. So thank you guys, and we'll catch you tomorrow.